Good evening, sir. So you're not audible.
Hello.
Hanji, sir.
Yeah. Good evening, everyone. This is the last webcast in this series that we started on Monday. It's been quite a enjoying it run for me. This is the first event that I've done on this budget, and believe me, more than anyone else, I've understood the provisions more deeply, and I keep getting new insights into it. Uh, so it's been a good experience in this full week running this webinar. So while we end today, we'll continue to try and bring out more such web seminars because the idea is that everyone should know, and the world is changing, India is changing. Uh, there's so many changes which are happening on an everyday basis. It's almost impossible to keep pace with whatever changes which are happening. You have notifications, you have amendments, you have clarifications, circulars, on an everyday basis, which kind of changes things significantly. And I mean, if it's a 6 month uh, gap, you'll see a lot of things have moved. So it's very important to keep oneself abreast with whatever changes are happening. And I think this is a good way. If not anything else, the lockdown has actually allowed us to communicate on a remote basis. Uh, and it saves us the time to travel, saves us the time to commute or to think whether I can reach that place or not. I mean, from the comfort of your office or your homes, you can just log in and get information. I mean, that's I think one of the most powerful things which has happened on account of this pandemic. So I'll just ask Palak to give a brief introduction, and then we can take this forward.
Sure. So, good evening, everyone. I welcome you all to the last webcast of Budget 2021 Unlock series organized by Acupro. Hope it was a good week long journey deciphering the budget. It's a well said proverb that all's well that ends well. So, today we'll look towards all the incentives the government has provided in Budget 2021. But before that, we'll learn about the prestigious institutions, the charitable trusts, and about CSR activities, that is, corporate social responsibility activities. The two define nothing but generosity towards the society. We'll see how generous the taxman has been towards them in this budget. So, participants are requested to use the chat box to take up their queries or can ask directly at the end of the session. Now, I request respected Alok sir to take over.
Thank you, Palak, and I must commend you for all this introduction over the 5 days. Thank you for that. Uh,
Thank you.
so let me start with this. So as Palak mentioned, uh, let's start with what changes the budget has brought in as regards charitable trusts. Uh, and this is important because more and more corporates will now go and set up charitable trusts because they have this obligation of incurring or spending on corporate social responsibility. They have a corporate social responsibility under the Companies Act, and so most of them will would want to uh, spend money through a charitable trust that they incorporate on their own, because that's one of the ways that they can spend or meet their responsibility. So it's important that one understands how taxation of trusts happens and what's the change which has happened there. Uh, so before the trust, a quick small change in the running of the universities and hospitals. There is this section 1023C which grants exemption to income earned by educational institutions or hospitals which are existing solely for educational or philanthropic purposes and not for the purposes of profit. And they are exempt if their annual receipts do not exceed 1 crore. This is what the provision is as on date. With effect from financial year 21-22, the annual receipts limit has been extended to 5 crores. So that's a significant jump. So I think the clear idea is that they want to promote educational institutions and hospitals, and any income which such institutions and hospitals earn on that, uh, provided the annual receipts are less than or equal to 5 crores, they will be exempt from such incomes from tax. Uh, and in case there is an institution which runs both educational institution as well as a hospital, then this limit is a combined limit. So the limit has been enhanced from 1 crore to 5 crore. Now, coming to the charitable trusts, so under the existing provisions, if anyone makes a voluntary donation to a charitable institution, uh, those donations are exempt in the hands of the charitable donation institution if the charitable institution spends at least 85% of that amount on charitable activities. Apart from that, there is also another category where voluntary donations are exempt, and that is if the donations have been made with a specific direction that such donations should form part of the corpus of the charitable trust, then also same is exempt under section 11(1)(d). And a similar thing we will find in section 1023C also. Now, any charitable donation, any donation towards corpus of the charitable trust was fully exempt. Any other donation wherein no specific direction was given, but as long as that donation, 85% of that donation was spent on charitable purposes in India, then the trust was not taxable in respect of those donations. And then there was this thing that in case where application of that money or that donation fell short of the 85%, then the trust could accumulate the shortfall. And for that, it has to file a form and all. Uh, and that shortfall can then be applied in the next 5 years. But the only condition there was that that accumulation had to be kept in specified modes. So it couldn't be like, I mean, you're using that money for something else. So that accumulated amount, which was equivalent to the shortfall, uh, that had to be kept in mode specified in section 11(5). Now, as the section stands today, there is no specific requirement to invest the corpus funds. So it just said that any donations with a specific direction that it should form part of the corpus fund, that is fully exempt. But there is no stipulation presently as to what needs to be done out of this corpus funds. So as a result, considering that money is fungible and it all lied in one bank account, a situation arose where funds received for corpus were also utilized for application of income during the year. So in the sense, you receive something on account of corpus and that's spent for charitable activities. And what the trusts used to claim is that I've spent so much on charitable activities and which exceeds 85% of my normal donations, and therefore my income is exempt. So this could potentially result in a double deduction or exemption of both corpus donation and application of income. So this is something which in this budget they've sought to, this anomaly has been sought to be rectified. So in order to overcome the situation of double deduction or double exemption, it is proposed to amend 11(1)(d) to provide that corpus donations received shall be exempt only if the trust invests such contributions in the mode prescribed under section 11(5). So now corpus donations have also to be invested just like unspent accumulated balances. It is further provided that application made by utilizing corpus funds shall not be treated as application of income, right? And the same will be treated as application only in the year in which same amount is invested back in modes prescribed in 11(5). So there could be a situation where a trust is carrying out a charitable activity, and for that it is pending, and it may so happen that the voluntary donations without any specific direction are falling short, while there are enough corpus donations, so the trust takes a decision, let me use the corpus donations also for charitable activities. So in such a situation, what is being told is that uh, it spending of corpus donations in that year will not be considered as application of income. It will be considered as application of income whenever the trust earns normal donations, and uh, then kind of makes good the corpus donation kitty by investing in the prescribed modes. So we'll just take a small illustration to drive home this point. Uh, so we've divided it into two columns, present and proposed. So there are general contributions of say 20,000 rupees, corpus donation of say 10,000 rupees. The total available funds with the trust are 30,000. Now the trust spends 25,000 on uh, charitable activities, right? Uh, so what is exempt in the hands of trust? Uh, the trust claims that okay, I have received corpus donation that anyways is not taxable, right? And I have spent 25,000, which is more than what my general donations are, right? So I am exempt for the full amount, and there is no taxability, right? Now with this change, what they're trying to do is they're saying that yes, you have total available funds of 30,000, and you have spent 25,000. But since you spent the entire amount of on or you spent the corpus part of your donation, you won't be getting exemption for corpus part of the donation. You have spent your 20,000, which is a normal donation, so you get that entire 20,000 as exempt. But the 5,000 that you have spent out of corpus will not be allowed as a deduction. Uh, so this is what the change is. Uh, Now, whenever that 5,000 is plowed back in subsequent years and invested in modes prescribed in section 11.5, then only that will be allowed, considered as an application of income. Uh, so, going forward, what should the trusts do? It is advisable that trust maintains separate investment funds as prescribed under 11.5 for corpus donations, and then receipt of corpus donation and use of such donation for charitable purpose must be tracked. Yes, the amended provisions will delay allowability of expense as application from the year of incurrence to the year in which corpus is recouped, right? And this amendment is also also covers entities claiming exemption under 1023C. Now, another change that they've done in the charitable trusts arena is uh, uh, they made a change in the how loan funds utilization is to be treated for exemption purposes. Now, what they're saying is earlier what used to happen, a trust, if it was doing a charitable activity and its donations were not enough to meet the expenses, it could go and borrow more funds. And then it could go and borrow funds and then spend that amount and then claim that the same has been used or same should be considered as an application of income. So this is what the trusts used to do. Uh, Now, and then when the loan was repaid, that amount was not considered as a application of income, and this was supported by certain judicial pronouncements. Now, the apprehension of the government is that uh, the taxpayers can claim double application or double deduction, once on incurrence of expenditure and again on repayment of loan, because some courts allowed that repayment of loan is nothing but application of income. So, in order to eliminate such double deduction, it is proposed to provide that application made out of loan funds should not be treated as application in the year of borrowing or incurrence of expenditure. The same will be treated as application only in the year in which the loan is repaid by the charitable trust. So again, a 1 year delay or a 2 year delay, or delay to the extent when the loan is repaid, that you get for claiming that there has been an application of income. Uh, so similar example, I'm just skipping this. Um, okay. Uh, the third change that they've done is that in the past, it has been consistently held by the courts that income derived from the trust property is to be computed on commercial principles. The trusts are entitled to carry forward excess expenditure incurred during the year over its income to subsequent year and set off the same against the receipts of subsequent years. So now an amendment has been proposed in section 11 and 1023C to provide that set off of excess expenditure in any preceding year shall not be allowed against current year's income. So whatever you have spent in those years remains as spent. You will have to your clock starts again. So no, you'll have to spend again in the current year, and you can't say that in the preceding years I had spent excess amount. So this amendment seeks to reverse certain decisions of the courts. Now, very difficult to understand what is the rationale for not allowing a set off, because someone might say that I spent in a particular year more than what I had earned or what I had received as donation. Allow me a set off in the subsequent year. Uh, but I think probably they might be looking at the fact that if you spent more, then probably that's in the nature of a loan. And so next year, when you repay that loan, you will anyways get an application for that. But I don't think that's coming out really from the amendment. So it remains to be seen how this would be panning out in the future years. Uh, so now I come to corporate social responsibility. This is not a part of the budget provisions, but this has come very near to the budget announcement of budget. So this came on 22nd January 2021. So CSR provisions have been there in the Companies Act 2013, but they were more of a recommendatory nature till date. Initially there were certain prosecution provisions, and then there was a lot of hue and cry and outcry from the corporates. How can you have prosecution and all that, and how can you criminalize? So then those provisions were taken away, and in 2020, I think in September or October 2020, they came out with uh, amended provisions and rules which suggested that there will be penalty provisions, and there won't be prosecution as such, but there will be penal consequences. Uh, and they also mentioned that what happens in case someone or some company doesn't spend this amount. So earlier there was no guidance as to what happens if a company fails to spend this amount. But these changes were to be effective from a date to be notified, and this date happened to be 22nd January 2021, and that's why this has become very important. So before we go into that, let's see how CSR is applicable on companies. So it's applicable on all companies, including a holding or subsidiary company in India. Uh, it's also applicable on branch or project offices of foreign companies in India. Now, what is the criteria? All companies would mean companies whose net worth is 500 crores or more, or their turnover is 1000 crore or more, or their net profit for the year is 5 crore or more. So these are the any one of these criteria any company fulfills, and there is a CSR obligation. Now, how much is the obligation? At least 2% of the average net profit of the company in the immediately preceding 3 financial years, or during such immediately preceding financial years if the company has not completed 3 years. So 2% of the average net profit of the immediately 3 preceding years. So which means if I have to find out my CSR obligation for 2021, I will know it beforehand, in the sense because my books of accounts for the last 3 years would have been closed. So I would know what's the average profit for till the year ended March 2020, and then accordingly I can plan my CSR spend in 2021. So this is what it is, and then it has been clarified that activities will not be considered as CSR if any activities are undertaken outside India. If those activities only benefit employees and their families, employees of the company and their families, if there is a donation or a contribution made to a political party, that's not a CSR activity. And similarly, if there are activities which are in the normal course of the business of that company, if it carries on something which it requires to do as a part of its business activity, that all activity will also not get covered in the CSR. Uh, so there is Schedule 7 which prescribes what would be CSR activities. So these are some 10 activities which are there. Eradicating hunger, poverty, malnutrition, promoting healthcare and sanitation, promotion of education, including employment enhancing vocational skills, promotion of gender equality, empowering women, reducing inequalities, ensuring environmental sustainability, ecological balance, protecting national heritage, art and culture, uh, then measures for benefits of armed forces, war widows and dependents, training to promote rural sport, nationally recognized sports, contribution to PM National Relief Fund and PM Cares Fund. PM Cares Fund only came last year after the pandemic, or any other specified fund. Funds provided to incubators, research and development with public funded universities, rural development projects, slum area development, disaster management. These are all the activities which are specified in Schedule 7. Uh, CSR has to be done amongst one of these 10. Now, what is the responsibility? So any company who has a CSR obligation uh, beyond a particular threshold has to form a CSR committee, uh, and that committee has to formulate and recommend to the board a CSR policy which indicates the activities to be undertaken, which would approve the CSR activities, recommend the amount of expenditure to be incurred on such activities, and will also monitor CSR policy from time to time. Once the CSR committee recommends, then the board will review the recommendations, approve the policy, disclose contents of CSR policy in director's report, and it also has to place it on company's website. Uh, Ensure that the activities that are included in CSR policy are actually undertaken. So that's also a responsibility of the board. And ensure that the earmarked CSR and pursuance of its CSR policy is actually spent. So it has to ensure that the activities take place and the amount which has been earmarked is actually spent. Now, how does one execute CSR activities? So a company may undertake CSR activities either itself or by making a separate CSR department in the company through a registered trust. So it can set up a registered trust or society. The company itself can set up that. Obviously, it will have to take a exemption under section or a registration under section 12A of the Income Tax Act, and that's where the taxation of charitable trusts is important. Uh, it can undertake CSR activities through an NGO established by the company or its holding company or a subsidiary or an associate company or any other NGO with an established track record of at least 3 years in undertaking CSR activities. So it can also go to a third party NGO. Uh, it can also collaborate with other companies for undertaking projects or programs in such a manner that CSR committees of respective companies are in a position to report separately on such projects or programs in accordance with these rules. Now, in order to monitor such activities, what they've done is that every entity that intends to undertake any CSR activity will now have to register itself with the central government. So there is a form CSR1 which has been prescribed, and this has to be filed electronically with the ROC with effect from April 1, 2021. And once the form is filed, a unique CSR registration number is generated by the system. Uh, The board should ensure that CSR funds have been utilized for the purposes and in the manner as approved by it. And the CFO has to certify this. Now, this is another significant thing. The CFO or the person responsible for financial management of the company has to certify that the funds have been utilized for the purposes for which it had been approved. And these are all changes which have been introduced by the company's corporate social responsibility policy amendment rules 2021 and are effective from January 22, 2021. Now, this is important. What are the consequences of non-compliance of CSR provisions? If there is a failure to spend the full amount that you have earmarked for CSR, the board should, in its report, specify the reasons for not spending the amount, and then it has to transfer unspent amount to a fund specified in Schedule 7 within a period of 6 months of the expiry of the financial year. Now, there's some confusion on what happens to CSR spend or CSR obligation which was not spent in the financial year 1920 or earlier, right? So I think there should be some clarification on that. But definitely, it appears that whatever is the obligation for FY 21-22, if that is not spent, then the company has to necessarily deposit this amount to a fund, and this fund could be either the PM Cares or the Prime Minister's Relief Fund or any one of those funds which are specified in Schedule 7. So we saw that in Schedule 7 there are these funds. So if a company fails to spend the entire obligation, then it has to transfer such amount to such a fund within 6 months. There is also an option for the company to, instead of contribute it to such fund, uh, undertake a project, in the sense wherein it will say that, okay, I want to do this CSR project which will be going on for more than a year, and therefore I'll need funds for this, and I'll need to generate funds or have enough funds to undertake this project. So in such a case, what is now being provided is that you have to transfer whatever is the unspent amount to an unspent corporate social responsibility account in a bank. So you'll have to keep this amount separately in a specific bank account, which will be known by the name unspent corporate social responsibility account. And this above amount can be shall be spent by the company within a period of 3 financial years from the date of such transfer. And if the company fails to do the above in those 3 years, then whatever it has to transfer the unspent amount to that fund again, specified in Schedule 7, within a period of 30 days from the date of completion of the third financial year. So, if the company has been unable to complete that project or uh, spend the full amount earmarked for that project within 3 years, also, then whatever is the balance that has to be transferred to the fund. So, essentially, the government is ensuring that if there is a CSR obligation, either the company actually spends, or if it is unable to spend, then all those surplus amount or unspent amount should be transferred to specific funds, so that government can make use of those funds. Then there is a penalty for default in complying with the above provisions. Uh, what is the penalty? The penalty is on the company as well as the officer in default. So on the company, it's twice the amount required to be transferred by the company to the fund specified in Schedule 7, or the unspent corporate social responsibility account, or 1 crore rupees, whichever is less. So if a company has an obligation of CSR obligation of 80 lakhs and it is unable to spend that, it has to either transfer to the fund, and if it doesn't transfer to the fund, then within 6 months, then it has to cough up 1.6 crore, or in this case 1 lakh 1 crore as a penalty. And it obviously the government would also require it to transfer the unspent amount to the fund. And similarly, there's a penalty on the officer on default, which is 1/10 of the amount required to be transferred by the company to the fund, or 2 lakh rupees, whichever is less. So now these provisions have now become mandatory. So earlier they were recommendatory CSR obligation, but now with the penalties coming in and all that, this has now become mandatory. So it's important that companies take note of this and start planning for the CSR activities. Uh, so going forward for financial year 2021, a company will have two options available to it to comply with CSR requirements. Option one: deposit the fund in government's account if it has not been able to spend that. And these are some of the funds where it can deposit: Prime Minister's Relief Fund, PM Cares Fund, Swachh Bharat Kosh, Clean Ganga Fund, or any other fund that the government uh, notifies. And this amount has to be deposited within 6 months from the end of the financial year, which is within September 2021. The second option is that it can identify a CSR project and deposit the fund in a bank account till it is able to spend that amount. So identify a CSR project, deposit that amount in an account called unspent corporate social responsibility account within 30 days from the end of the financial year. So by 30th April, it has to deposit it there. And then it should spend this amount within a period of 3 financial years from the date of such transfer. And if it is not done within that time, then it has to again, whatever balance is left, it has to transfer it to these funds. Uh, Now, what's an ongoing project? Ongoing project has been defined to mean a multi-year project stretching over more than one financial years, but not exceeding 3 years. excluding the financial year in which it has commenced. And it includes projects that was initially not a multi-year project, but the board extended the period beyond 1 year based on reasonable justification. Uh, so at the most, the project can be for 4 years, including the first year of commencement. Uh, Mere one-time spending cannot be a project. It requires continued spending over time. And year here means financial year. And so if the unspent amount at the end of March 2021, 22, 23, that should be transferred to a special bank account by April 30 of such year, and the unspent amount at the end of March 31, 2024 must be transferred to one of the funds specified in Schedule 7. So this is what will happen going forward. Uh, what will be considered as an ongoing project? There might be situations where a company has agreed for disbursement of amount before the end of the financial year. However, due to some reasons, the actual disbursement implementation has not been made, or project for which disbursement has been committed has not started. So in such a situation, while the actual amount is not disbursed or project has not started, we may say that project has commenced within the same financial year if the company has already made a binding commitment to disburse the amount. Uh, so it's not required that you should have spent at least some amount on the project in order that that project qualifies as an ongoing project. So this was on charitable trust and CSR. Now, coming quickly to some of the incentives that the government has, basically no new incentives, but just extension of some old incentives, extension by a year and all. For startups, there is this Section 80 IAC, which provides for deduction of an amount equal to 100% of the profits for 3 years out of 10 years. That has earlier this benefit was given to startups which were incorporated before 1st April 2021. Considering that this year has been a pandemic year, they've extended it by another 1 year. Uh, Similarly, there is a Section 54 GB, wherein if someone earns any capital gains on transfer of residential property, and the net consideration uh, 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 so the net consideration is then utilized to subscribe equity shares of an eligible starter. Then he was given an exemption under Section 54 GB. And this benefit was only available if the residential property was transferred on or before 31st March 2021. Now, this has again been extended by a year. Uh, on the housing front, they've given certain or extended certain benefits to the housing front, especially the affordable housing. Uh, uh, Deduction of loan has been extended uh, in case the loan is also obtained before 31st March 2022. Earlier it was 31st March 2021. So other provisions remain the same. They've inserted a new subsection 1A to provide benefit of deduction to rental housing project. The modalities would be notified by the government, uh, um, and that project has to uh, be there by 31st March 2022. And what conditions would be required? I think all that will be required to be fulfilled. I think that all will be there in that notification. And similarly, companies who were enjoying tax holiday under 80 IBA, their period is extended by one more year. Continuing with the housing sector, they have given a relief in order to liquidate the inventories of builders to the extent that they have said that we will increase the safe harbor of 10% to 20%, which means a builder can now sell his flat at a price which is less than the circle rate or the stamp value, and the difference could be up to 20% instead of the 10%. But then in this case, the house has to be purchased between 12th November 2020 to 30th June 2021. Why 12th November? Because the government came up with a notification or some, I think, probably an ordinance at that point of time, uh, that this is the relief that they're giving in order to make sure that uh, you know, people actually go and buy flats. And the consideration for the flat should not be more than 2 crore. This is another uh, thing. And plus, the transfer is by way of first time allotment of residential units. So it can't be a secondary sale. It has to be a first sale by the builder. So this is a benefit which has been given to builders for liquidating as well as to buyers to buy at a price which is more uh, close to the current market rates. Uh, a small rationalization in the TDS provisions. So earlier, FIIs were governed by the taxation is governed by Section 115 AD, uh, and in terms of that, obviously they are allowed to obtain benefits under the tax treaty also if they comply with the conditions. However, there was this section 196D which talked about TDS on payments to FIIs, and that section specifically only mentioned rate of 20% as TDS rate. Uh, and it did, unlike in section 195 where the expression uses rates in force. So what was happening is whenever Indian companies started declaring dividends in uh, 2020 and 2021, uh, they were stuck by this section 196D and they had to necessarily withhold tax at 20% plus surcharge and cess. Uh, so even though the FIIs produced a TRC and other documents to claim that they are eligible to be governed by the treaty provisions and therefore a lower withholding should happen, because of 196D, there was a flat deduction of 20% plus surcharge and cess. And this was also kind of this position was blessed by the Supreme Court decision in the case of Pilcom. But obviously, Supreme Court also said that under 196D, the companies will have to deduct at 20%. But the FIIs are free to go and claim a refund by filing a tax return and be governed by the provisions of the treaty. So, in order to reduce that pain, they have come up with this thing that even for 196D, if an FII is claiming a DTA benefit, then the rate of 20% will get reduced to the rates in force. So this is a rationalization provision. Uh, there's another small change that they've done. They've said that issuance of zero corporate bond by infrastructure fund will also be permitted. Earlier, this was only allowed by infrastructure capital funds. Now it will be also allowed by the infrastructure debt fund. Uh, so I think this is probably to give a push to the infrastructure sector, and probably there would be some zero coupon bonds which will come up now. Now, the advantage of a zero coupon bond is that these bonds are issued at a discount, depending on the period for which these bonds are there. And then there is a redemption at face value, and the difference is taxable as capital gains and not as interest. So that's the advantage of a zero coupon bond. So this is on the, I think there would be some, this is with this I come to a close to this session. I know this was a shorter session than the earlier sessions, but I'm happy to take any other questions that you may have uh, on this. Palak, you can maybe unmute everyone.
Yes, sir. The participants can take up their queries.
So I can understand that this session was a little more specific for charitable trusts and CSR, and did not have much to do with a day-to-day working. But nevertheless, I thought this is important. Some residual provisions should also be looked at, because what happens in a budget exercise, the focus is always on the key amendments, but there are certain other amendments which have a significant implication, but they kind of tend to get missed out. So just for the sake of completeness, there are some other changes also, like international financial service centers and all that. I've not taken up them here because those are very specific, and those can be discussed offline. Uh, but I think this is an attempt from us to uh, start a series wherein we go deep dive and look at all provisions in more detail. Because generally budget provisions are announced, and then there are seminars across 2 hour seminar, 3 hour seminar, or 2.5 or 1 hour seminar. And we believe that those seminars are good to get a glimpse of what has happened. But if one wants to really deep dive, then a more focused series like this would be more useful, because then there is a better analysis by the presenter, and it's easier for the listeners to grasp uh, two topics in a day than to get everything in one go. So that was the idea, uh, and I thank you everyone. In case anyone has anything to say, I'll be most happy to answer. Uh, Okay, thank you very much. So I'll close this session for now. I thank you all for being a part of this session. And as mentioned yesterday, uh, we will put this on YouTube. So you can access them whenever you want on the Acupro Consulting YouTube channel. This will become a repository, and so this can be referred by anyone. Uh, and hopefully we will continue with such kind of sessions in future also. I'm sure we will do that. I'm planning for something on India's next month. Let's see how it goes. Probably that should be very informative as well. Uh, so let's see, and we look forward to be in touch with all of you. Thank you once again. Thank you.
Thank you, sir.
Thank you. Thank you all.
Thank you.
Thank you, sir.
Thank you,
Thank you.
Alok.
Thank you, Ashok.
Thanks,
Thank you,
Alok.
sir. Thank you.